Alright, so basically today I'm going to be covering the tape reading chart. Alright, this is like the original footprint chart, and it was devised by Wyckoff a long time ago before footprint charts came out. And it's just volume and price. So footprint is just volume and price, right? So using a candle. So in a candle, let's say you go from 70 to 71 with penny increments, you'll have 100 prices, and each price would have a volume. So you'd have a profile or a volume profile from 70 to 71, indicating the price, indicating the volume traded at each price between 70 and 71, and there can be 100 prices, so it'll show the volume distributed across 70 to 71. On a point and figure, if you have 10-cent boxes from between 70 and 71, you'll only have 10 prices, and each price would be consolidated. 10 prices would be consolidated because the box size is 10 cents, and their volume would be consolidated. So, I mean, it's just a level of detail. Do you want to see volume at each individual price, or do you want to see it consolidated so you don't see 100 prices with volume? Instead, you just want to see 10 prices with volume. So this level of detail is what, the footprint chart varies depending on whether you have it on a point and figure or a candle. It's just volume and price, but you can combine those prices to give you a consolidated view of how much volume traded either at a single price or a range of prices. All right, so that's all. This is an example of what Wyckoff did. And the key things is, he was like, okay, I'm short. Where do I cover? All right. So it kept on going down, and he noticed weak rallies. He noticed a weak rally over there, somewhere I think over here. Then he found a little base over here, and then finally, when it went here under 83, there was a base developing, and he had pointed out that the 10 right here and the 17 that he had mentioned. Why is that important? Because the 10 and the 17 are high volume prints, right? So that's a pretty important thing, because it could be a change of behavior. The 10 is 1,000, and that's bigger than 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 1, 2, 3, 4, 5, 6, I don't know what this is, 7, 8, but like, I don't know, it could be a lot of prints. So it's a big print. Why is that important? At the lows, big prints come in. Why? They're buying. So especially after you have climactic action or the market is oversold, you have the high volume prints because it's just buying low. And you mentioned the 10 and the 17 as 1,000 and I think 1,700 shares, and it holding, meaning it wasn't breaking, it was holding, and then finally popped up, broke out, and all of that. And he was talking about cover your short and go long. All right, so I'm going to explain this, but in a different way. That's I don't want to get into all of the small lot trading and all of that, and simply explain the tape reading chart, today's tape reading chart, or the adaptation of the tape reading charts that I have. And the idea is it's very similar, but with very common behaviors that everyone understands and can be used specifically for trading. Like not becoming an analyst, because analyst for the purpose of trading, not analyzing so you know what every single behavior on the chart means and what it's trying to do, and the small lot trading and interpreting all that will lead you down the wrong path. So you want to know, where is there an opportunity, an edge to get in, and how do you get out? All right. So this is his chart. He combined it with the wave chart. This is a tape reading chart. you would combine it with the wave chart. So above or below it, you would have a wave. So, you know, it'd just be waves going up and down. All right. All right. So let's go into how to read the tape reading chart in an easy way. Okay. So the first thing you have to understand is what is volume. So there's a lot of, you know, I've seen entire books written on volume and this and that, and everybody has an opinion. But volume is input. Okay? Price movement is the output. You have to understand volume is the input, and how much price moves. This is why they call it effort is the input, and result is the price output. All right, so you all know about effort result or effort reward, all right, whatever. Okay, so volume is input, price movement is output. That is the foundation. Now there are two key behaviors, all right? When you have volume, let's say this is high volume, you say, okay, this is the input, right? You have a price level, let's say, I don't know, whatever price level, there's high volume. What is the result of that? If it starts going up, right? You know that this volume was the effort, and the result was like the Eiffel Tower over here. All right? Now, what about if you have, instead of high volume at the bottom leading to the effect or the output of price going up, what if you had volume up here? So it's a up bar, but you have volume up there. What is that? Is that bullish? The answer is no, because it has no effect above it. All right? So in the first case, we're going to just assume that there was a base before it, right? And you had this high volume here, or you had it here, or you had it here. Okay? Any one of these spots, you know, and then you had follow through boxes or follow through prices. This is, you all know the breakout volume, right? So that is good, it's bullish. Now if you had the same thing, but the volume comes up here, and there's zero or very little follow through, like maybe a box. Let's say there's no additional, or there's very little. This is a problem. This is not breakout volume. This is not accumulation volume. Here, these two boxes would, well, this would be breakout volume as well. This would probably be some type of accumulation, but leading to, you know, higher prices. The key is it's cause, not cause, but effort and reward, or input and then output. Effort, buying, reward, increasing in prices. Okay, here you had buying, but was there any increase? There was a very little or no increase. So let's say if this was at the top, does price go higher? No. In this case, in the second case where it's in the second to the highest box, it only goes a little bit higher. What is this? And what is this? This is bullish. And basically, let's just call it breakout volume. All right, let's just keep it simple. Breakout volume, everybody understands what that is. This is effort. All right, breakout volume bullish, and it's a continuation signal. Effort, stopping. It's stopping action. You could call it stopping action or bag holding or distribution. All right. So the first one is bullish. Is breakout. We'll just call it breakout. And the second one is effort. All right. So we all know what this is. Breakout, you have volume, and then you have continuation above it. Effort, you have zero or very little continuation. Again, zero or very little continuation. So it is stopping action, and it is evidence of distribution, especially if after that you have boxes, prices that trade below. Then you know that this is distribution, because that volume was selling high in order to go lower. So these are the two basic models you need to read the tape reading chart. This is what you must understand, and with this, you're equipped to read the tape reading chart with these two behaviors. This is on the up waves, right? Meaning it's in the uptrend. You have breakout, and then you have effort. And the downtrend, what do you think you're gonna have? You have breakdown, and you have effort. Okay. So now understand, these are the only two behaviors if you have this basic understanding, you can start applying it and understanding the tape reading chart, and I'm going to show you how to do that now. All right. Today, I think this is today's action. All right. Where do we want to go? So start at the start of the trend. So it's going down, 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 down. Okay. So we'll just start at the bottom. All right, let me just change something. Okay, now you cannot read everything, so just, anyway, you'll get the picture. All right, so the red boxes identify high volume, and what we're seeing is whether they have follow through. If they have follow through, it's breakdown volume. If they don't have follow through, it's effort. Okay, they may have follow through on the same column or the next column. So we'll start here. You could also start here. You notice extremely high volume, and specifically you notice the 79 print. How much follow through does it have? It has little to very little to no follow through. That's climactic effort, or whatever you want to call it. Stopping action. Okay? Bag holding. Okay, someone's selling, the other side is buying. All right, go to the next one. Very clear, it goes from 23 to 46, almost basically double. Does it have follow through? No. So what is that? That's effort. Now we move sideways. Remember, we're just two behaviors, effort and breakouts. We're only going to focus on that. And one is you have a lot of follow through, and the other is you don't. Breakout, you have a lot of follow through. Breakout or breakdown, you have a lot of follow through. Effort, you don't. Breakout, and breakdown are continuation signals, whereas effort is reversal signal. Bag holding, and you should get ready for the reversal. So here you have a lot of volume. You have little or near zero follow through. There's something going on here. This is distribution here. Attempted to go down on the 46, has almost zilch follow through. What is that? That's effort. And now it gets taken out by higher prices, which is a form of confirming, meaning you have the effort and you have the reversal confirming the effort. Done. All right, next, you take a look at the 44. I think this is in thousands, so it's like, I think it's 44,000 contracts. Breaking, right? So you have the resistance, it's breaking. Does it have follow through? Yes, yes, yes. What does that mean? It's a breakout. Motherfucker. 1 second. This bullshit. Unbelievable. This is what I have to deal with. Can you believe this? Anyway, so you have this breakout and you have follow through. The follow through confirms the breakout's continuation signal. You might want to look for pullbacks. Why? Because you have a base and you have a breakout and you have follow through, blah, blah, blah. Right? So now we're just going to continue. There's some effort up here, an effort up here, and then you have a pullback. I go over here. There's some effort to go down. Does it go down? No. What happens? Goes up. There's some effort up there with a 3 and the 8. No follow through. This is a problem. 3, no problem. It's going to go down. Then you have some effort here, and it reverses. Okay. Reversal confirmation. There's a tendency to go up. Right? So it keeps on doing this. And eventually you have this effort here and a big reversal. So that means it's going to go the other way. Because it's a very simple principle. If you have a lot of volume and it's not going down, it's going to go the other way unless you have a lot of volume, and that other way, meaning the upside, is not moving. Then it'll try to go back down. So in this case, you had 32,000, then you had 56,000. 56,000. And it's not going down. It only gives you one little O. There's a problem here. And once it goes the other way on heavy volume, you know the direction. It's higher. Okay? And now it's going to become fairly easy. I mean, you have from the low, you have this 27 print, right? What comes above it? I mean, do you have continuation above it? You do. Boom, 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 boom. Legitimize, because you have that high print 27 with the follow through to the upside, it means it's bullish and you have continuation signal, meaning they cleared the path to go higher. Now it consolidates. You have that 32, 31. What does that mean? That is buying. But do you know? Not until they take it out. Not until it goes up. Now over here, it didn't go up on the same column, but it did go up on the next column. Boom, boom. Now what else do you have? You have the next column, and you have the 30. Right? It goes from 15 to 30. More than double. After that, do you have follow through? Yes, you have even more volume, and then you have follow through. Bullish. What does that mean? That means breakout continuation signals. It's giving you continuation. Now it comes over here, the 89, and then you have 40 and 80, 26 and 34. What is that? Bullish? Yes, it is. Why? Because you have follow through. 89 cleared out the highs of the prior bar, and you have follow through. They cleared the path. You have a pullback, And this is interesting. Right here, you have 39,000 traded, right? Which is the highest in this bar. Do you have anything, any follow through? No, that's effort. Moving on. Here, very clear, you have a 72. What happens after the 72? Price goes up, 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 clearing the path, which means continuation. Which side? Upside. Now you have all this shit over here, and I don't know, the number, it's probably early in the day, so that's why the numbers. Right now at around 8:45 or 8:30, you have, what do you have? You have increase in volume of 6 and 20, right? It's even highlighted in green. And then it goes up, 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 giving you follow through. What does that mean? That means yes, continuation. It's not effort, it's breaking out, legitimized with the follow through. And it comes back and tests. And what happens here? You have that 30 with barely any follow through, and it just reverses. Keeps going, keeps going, keeps going. There's the break, 37 above the prior high, has higher volume, and it just keeps on going, right? Where it gets a little troublesome is when you have the highs having the highest volume, and you just have to see, is it because it's breaking out, you know, that it has that, and just, you know, people are just buying the buys, you know, when there's a problem is when it's really high and it starts breaking to the downside, right? Like this is end of day, so you know it's no real deal, but right there, 113, right there. That 113, if the market dropped here, for sure, that right there is the breakdown, and bias is on the downside. Why? Because selling came in and it had followed through. So that's valid breakdown. It's not effort. Okay. So what do you learn from this? You learn that basically this is the tape reading chart. The modification I made to it was with the X's and O's, I added a candle for better visualization. Second, I want to highlight certain volumes because it just helps me read, because too many numbers I go cut nuts. So this makes it like puts my focus on where it should be. And the third thing is whenever the volume comes in, right? Volume is the input. The result of that volume is what you need to see. Is when the volume comes in, do you get follow through? If you got green volume, do you have follow through? If so, it's clearing the path for buying pullbacks. If you don't, there's a problem, meaning if the green boxes or the high volume is at the top, there's no follow through because you're at the top, right? So that means typically you have to wait until the next bar, and the next bar might be going down. It may go up. If it goes up, then yeah, legit, and it's bullish. But if it goes down, then you have to wait. And that doesn't mean you go short. You don't go short until you have breakouts to the downside. Very clear, the trend changes and you have breakouts to the downside. And when you have those breakouts to the downside, you have the same thing. You have high volume come in, which is the input, and then big candles going down, which is your follow through reward. This is a very easy way of reading the tape reading chart that I'm showing here, or any footprint chart. You should be able to apply this to footprint charts. You know, it's the same shit. All right, understanding again, volume input, the price movement that happens after the volume being the output and determining whether it is clearing the way for a continuation trade or whether there's bag holding and distributive action at the top because of a lack of follow through, and it is a concern if you are long. All right. If you want to learn more, you can just get the Wyckoff course. I think it's online, and just get a footprint chart and just start reading it. And I think it's definitely going to help, especially because the wave charts by themselves, I know Wyckoff says they're adequate enough, but a lot of times it makes a difference if you have this, because this, as you can see, what it's doing, it's profiling the prices. It's like a volume profile on the prices, and on top of it, it's consolidating the prices so it's not too much. So again, you gotta go get the Wyckoff course, read that, learn that, and then get a footprint chart, put the volumes, I mean obviously the volumes are going to be there, and then just start reading them. And the way you want to read them, right, because there's a lot of numbers, you want to read them up and down, all right, and see if the volumes are going up, meaning let's say you go from 6 all the way to 20. Does that look normal to you? No, it's more than 3 times the volume. So you went from 6 to 20. In fact, you went from 2 to 6 to 20. 3 times. So you can, the way you read that is as it's going up, absorbing and buying more, right? So you want to read that up, and then on the breakdowns, when it's going down, over here you have 5 and 113. So you want to read it top to bottom, seeing the increase and how much of the increase there is. And then, of course, the reward or the follow-through continuation to the downside, right? And you can read this chart using this simple 2 behaviors of breakout and effort, and combining that with trend, if it's going up or down. And I think that's about it. All right, take care. Bye.